Welcome to Highway Herald, your roadmap to the latest in auto. Today we're diving deep into the world of electric vehicles. As the leading force in the EV industry, Tesla's performance often mirrors the state of the market. Each rise or fall sparks intense scrutiny, providing insights into the current direction of the EV sector. Lately, the focus has been on a downturn. Tesla's recent stumble is a clear sign of a potential market collapse. Let's delve into 6 key indicators that highlight this trend. Indicator number 6. The anticipated second wave of growth is stalling. If you've been keeping up with the news, you might be aware of reports from Reuters suggesting that Tesla is discontinuing the Model 2. Elon Musk has criticized readers on his X platform, but he hasn't outright denied these reports. The Model 2, which was anticipated to be Tesla's next major project, now seems unlikely to materialize. Industry experts predict that this EV won't be ready within the next 18 months, as Tesla shifts its focus to the robotaxi project, with its premiere expected in August. This vehicle is set to be the company's first autonomous taxi. What implications does this have for the broader EV industry? The growth of the EV market has slowed down after several years of rapid expansion, and in some regions it's even regressing. This suggests that the early adopter phase has ended, and the middle class isn't quite ready to adopt EV technology due to the high costs associated with electric cars. The Model 2, with its affordable price tag of between $25,000 and $30,000, was expected to be a game changer, offering an affordable EV with impressive range and technology. However, it now appears that this won't be happening, indicating that other EV manufacturers may follow suit. With the latest EPA proposal, it's clear that rapid electrification isn't on the horizon, leading many companies, including Tesla, to delay their EV projects. Indicator number 5. Declining sales and profits. Tesla, once a beacon of rapid growth in terms of sales, profits, and stock prices, is now facing a slowdown. The company's sales were on an upward trajectory until recently, but the profit margins remained slim due to a price war. Just last week, Tesla slashed the starting prices of its models by $2,000, bringing the Model Y down to approximately $44,630. This significant discount, coupled with other investments to maintain its industry leadership, led to a 55% decrease in Tesla's net income in the first quarter of this year. Total revenue also fell by 9%, amounting to just over $21 million. Various challenges, including the Red Sea conflict and an attack on the Gigafactory in Germany, contributed to a 17.4% decline in growth in the previous quarter. Sales, which are down 8.5%, pose the biggest problem. While this drop might not typically raise alarm bells, it marks the first time in 4 years that Tesla's sales have declined. These figures, while not alarming, are indicative of the broader EV industry state. Tesla has been the only car maker turning a profit on EVs, while legacy car makers and EV startups have been bleeding money due to their inability to optimize production and cut costs. With the current slowdown, massive discounts, and other profit-impacting factors, it's no surprise that most companies are delaying their EV investments. Some, like Fisker, are on the brink of collapse, while Rivian is grappling with record-low stock prices. Indicator number 4. The Cybertruck recall. The long-awaited Cybertruck has finally hit the roads, but its journey has been far from smooth. Just weeks after its launch, complaints about subpar build quality began to surface. One of the most concerning issues was a poorly designed accelerator pedal and cover that could potentially cause the vehicle to accelerate uncontrollably. The National Highway Traffic Safety Administration had no choice but to issue a recall, citing an unauthorized change in lubricant used in the assembly of the pedal pad as the cause of the malfunction. This recall is a stark reminder of the challenges facing EVs. A recent Consumer Reports survey revealed that EVs are 80% more problematic than their gas-powered counterparts. Tesla, despite being one of the more reliable EV manufacturers, is not immune to these issues. Other EV manufacturers are grappling with even bigger problems, with some, like GM, being forced to halt sales of certain models due to persistent software issues. Before we delve deeper, we'd appreciate it if you could subscribe to Highway Herald. Your support fuels our passion to create more content like this. Now let's explore indicator number 3, widespread job cuts. The precarious financial state of many EV manufacturers has led to a wave of job cuts. Tesla, for instance, recently announced a 10% reduction in its global workforce of over 140,000 employees, resulting in more than 14,000 job losses. This is a clear sign of the company's efforts to reduce costs. Interestingly, It's not just rank-and-file employees who are affected. High-profile figures like Drew Baglino, Rohan Patel, Rebecca Tanucci, and Daniel Ho have also left the company. Whether this is a sign of a sinking ship is yet to be determined. Of the 14,000 layoffs, 6,700 are in North America, affecting plants in California, Texas, Nevada, and Buffalo. An additional 400 jobs will be lost in Germany, while the majority of layoffs will occur in China, where Tesla recently experienced a significant 43% drop in sales, selling just 300,000 vehicles in the last quarter. This situation mirrors the broader EV industry. With companies desperate to cut costs, layoffs are widespread. Rivian recently announced a second round of job cuts, following a 10% reduction in February. Ford and GM are also reducing their EV plant workforce, while Fisker has sent a letter to its employees hinting at the company's uncertain future. Indicator number 2, the fall in China. China, once hailed as the world's most promising EV market, is experiencing a slowdown. The market, once bustling with cutting-edge and affordable electric cars, has seen a dip in growth. Tesla, despite intense local competition, had been faring well in this market. However, the tide has turned, with the last quarter witnessing a significant 43% drop in sales, resulting in only 300,000 vehicles sold during this period. Simultaneously, Tesla finds itself embroiled in a price war initiated by BYD, a domestic competitor. This has led to substantial price cuts on Tesla's Model 3, Model S, and Model Y, amounting to thousands of dollars. It's evident that Tesla is now operating at a loss on its EVs in China. The sales slump has reduced Tesla's share of the Chinese EV market to a mere 10%. While this still secures Tesla's position as the second largest player in the market, BYD's one-third market share is widening the gap. Indicator number 1, the rise of hybrids. As Tesla's sales numbers dwindle and the overall EV market stalls, it's clear that consumers are hesitant to fully embrace EVs. Instead, they're opting for a more gradual transition to electrification by choosing hybrids. The latest sales figures speak volumes, with hybrids experiencing a massive 70% growth in North America last quarter, accounting for 9% of the US market. This is a significant lead over EVs, which hold a 7.2% market share. Toyota, the world's leading hybrid maker, is reaping the benefits of this shift, with record-high sales numbers and profits exceeding $30 billion last year. Does this signal the impending collapse of the EV market? It's hard to say. What is clear, however, is that the middle class is not ready to adopt electric cars just yet. Instead, they're choosing hybrids for their affordability, reliability, and convenience. With hybrids, there's no need to worry about range or charging. When you consider these factors, it's easy to see why many consumers prefer a gas-electric combo over pure electric vehicles. Thanks for joining us on this deep dive into the world of vehicles. Don't forget to subscribe to Highway Herald to stay updated on the latest vehicle trends and upcoming videos. See you next time.